You read the title right. The FHFA's Safety First Playbook could help trigger the biggest multifamily failure wave by 2026. Not because they raised the bar, because they kept it low. 61% low income, 14% very low income, and a capital-first mindset that pulls back risk when debt needs rescuing. Here's the twist. Stability for Fannie and Freddie means less liquidity when projects hit rate resets and rent softness. We'll connect the dots. How conservative goals, elevated rates, and capital shortfalls create a vacuum exactly where highly leveraged deals are most fragile. Stay, and you'll know which assets get hit first. You saw those targets and thought, cool, more affordable lending is coming. 61% low income, 14% very low income. Sounds like a hose of liquidity. So why are sponsors calling brokers and hearing crickets when they ask for a rescue refi? Because the hose is on, but the nozzle is barely cracked open. Here's the thing, the FHFA is keeping a conservative posture. Benchmarks held, safety first tone, and they keep reminding everyone the enterprises have capital shortfalls. On paper, that reads prudent. Guard the balance sheets. Don't sprint into a wall of risk. It plays well in a memo. It plays badly when your ARM resets next quarter. But here's the catch. When Fannie and Freddie put capital first and try not to crowd out private capital, they dial down risk appetite right as multifamily loans hit rate resets. The timing is brutal. The signal to lenders is clear. Meet goals, but do it clean. That means the marginal, messy, distressed refi? It's not the path of least resistance. Think of the benchmarks like guardrails, not accelerators. You can hit the goals with plain vanilla loans. You don't need to stretch on a bruised value-add deal or a half-stabilized rehab that missed rent growth. Lenders can check the box without touching the hot stove. So they don't touch it. You're left with a yes for safe paper and a circle back next year for anything that actually needs help. And the agency spells out why. They warn about pricing distortions and crowd out of private capital. Translation: no more sugar rush from aggressive subsidies. When they throttle G-fee breaks, waive fewer upfront fees, and cool cash window incentives, you lose the grease that makes workout refis pencil. A quarter point here, a fee waiver there. Those tweaks used to bridge the gap. Pull them back, and the math stops working. Now stack the macro. Higher rates, stricter underwriting, fewer pricing subsidies. Developers walk in with a 1.25 DSCR plan and leave at 1.05 after the stress tests. Proceeds fall. The equity gap shows up like a parking ticket under your wiper. If the sponsor can't write the check, the choices shrink fast. Sell at a discount, beg the mezz lender, or hand back the keys. And don't expect goals to go counter-cyclical. They flex with the market. The models lean on market share and macro indicators. Think ARIMA forecast logic. So when the market tightens, the targets move with it, not against it. That means the cavalry doesn't ride in during stress. It just marches at the same pace as the crowd. This isn't just theory. Certain property types and loan structures are lined up for 2026 like bowling pins. Floating rate with caps expiring, bridge debt tied to business plans that stalled, and assets where expenses sprinted and income jogged. You're not ready for what those refinance quotes are going to look like when the cap costs aren't subsidized by momentum, and the agencies won't backstop the edge cases. So, mini payoff right now. The goals do protect the GSE balance sheets. They achieve safety and soundness, but they also starve the riskiest deals of oxygen. The pool stays clean by keeping the swimmers who need help out of the deep end. Stability for the enterprises becomes instability for owners, sponsors, and their lenders staring at maturities. And this is where it gets real. The blast radius isn't random. It has a shape and a schedule. Certain assets go first, and the clock is already ticking. So who's actually in it, and when do they tip? Let's name names and timelines. There's a calendar on the wall, 2026. And some properties have a red circle on it. You already know the vibe. The stack that trips first isn't mysterious. It's the short fuse debt. Bridge loans coming due, March 5th. 7-year ARMs rolling off teaser periods. Floating rate paper with hedges expiring. And value-add plays that were supposed to ride rent growth but stalled out. If that's your cap table, You're on the clock. Let's break it down. Bridge lenders wrote big checks on pro formas. Those loans mature into a market that pays less for the same income. Agency arms that looked smart in 2021 now reset into a new reality. Floating rate borrowers are staring at cap renewals that cost more and protect less. And the classic value-add story, new kitchens, bump rents, refi, repeat, hits a wall when the rent bump didn't land or landed late. Now the tension, rents cooled, expenses didn't, insurance punched numbers in the face, property taxes came in hot, repairs and labor keep creeping, debt costs didn't slide back to the cheap money era, so DSCRs drop. LTVs creep higher because valuations reflect thinner margins and higher cap rates. Underwriting cuts proceeds and raises conditions, and your "will grow into it" thesis meets a funds short email from the lender. Where does this bite hardest? The Sunbelt pockets with heavy deliveries. Lease-ups that expected a sprint now jog with concessions and flat rents. Class B and C in secondary markets feel income stress because tenants are tapped out and local employers aren't bidding up wages. Workforce units hit a ceiling. You can't push rents fast enough to outrun interest expense plus higher taxes, insurance, and maintenance. It's not doom, it's math. Here's the research-backed angle. Broker maturities sheets show a bulge of 2025 to 2027 debt. Layer in supply pipelines from places tracking new units. Lots of keys hitting in that same window, while absorption looks tepid. You get a timing mismatch. More doors chasing the same renters right when lenders ask for more coverage. That's how a small wobble turns into a refinancing problem. Now the refi math that ruins afternoons. You took out debt at 3.5%. The new money wants 6 to 7% or higher. At the same NOI, your loan size shrinks. Think 20 to 30% fewer proceeds, sometimes more if the lender stacks stress tests. That creates an equity hole. Many sponsors don't have that checkbook. They burned reserves stabilizing, or they held caps that are now expiring and expensive to replace. Fresh capital gets picky, and preferred equity wants terms that turn you into asset manager of your own deal with no upside. Tie it back to the safety-first posture. Those multifamily goals aren't moving counter to the cycle. They stay steady, which means the agencies won't swoop in for the hairier refinances. If you're expecting program tweaks to stretch leverage or cut fees on the edge cases, don't. The gap stays a gap, and that's what pushes marginal deals to sell or surrender. Name the pain points. Small balance multifamily with tired roofs and 1970s plumbing. Tertiary markets where private label buyers are scarce, and local banks are de-risking rather than adding new exposure. Those lenders quote conservative proceeds and long timelines, or they pass. Cap costs plus soft rents plus thin liquidity? That's an ugly trifecta. So, mini payoff. First to fail are the floating rate, value add, or bridge-backed assets in overbuilt markets with operating costs climbing and caps expiring. It's real. It's happening. If the safety net won't stretch, what do you do? Whether you're an investor trying to survive the refi, a lender staring at maturities, or a community that needs these units to stay online,